Hello and welcome back. I wanted to make a video about AMD, a company that has been enjoying explosive growth as you see here, although lately has slumped a little bit just because pretty much the whole market has in the Nasdaq, so you would expect this kind of move here. The thing is, we want to examine whether it's actually worthwhile to get some AMD right now, and that should be based off of financials of the company. And this is why we're gonna take a deep dive and also create a discounted cash flow model to see what kind of price it makes sense to pay. You may be a bit surprised and not expect what you're gonna see out of that model really. Because you need to remember that whenever we're examining a stock and a company to purchase, the investment that we make is gonna yield some free cash flow to us. Because when we're purchasing a stock, the only thing that we get back from the company is the free cash flow it's going to generate. And so it's not like we're going to be getting the equipment that the company has or the factory or anything of that sort. What we buy when we're investing in a company is the free cash flow that the company generates over the next few years. And as stockholders, we get some percentage of that, some ownership of that free cash flow. And so we want to be making sure that the free cash flow that the company generates, when discounted for today, because the free cash flow that the company generates 10 years from now has less value than today if it was generated today. So we need to discount it. And with our exclusive tool, the tool that I have created for this channel, we can do all that automatically. And this is what we're going to be doing next after we examine the financials here. So you will see that the company has been enjoying some incredible growth over the last few years. And right now it's dropped a little bit, but still 27% up in the last year. So this is great for the company. So what's happening with the income statement here? Let's take a little bit of a closer look at the financials. You will see that the last couple of years the company has enjoyed some tremendous growth over here, which is much more than what it used to be. Now this may have to do with the need for semiconductors in the last couple of years during the pandemic. So this explosive growth must have had something to do with that. So bear that in mind. It may not be as explosive in the next few years. Now, the net income of the company has also been increasing, and it's very interesting to see that the company was actually not making money in 2017, but in 2021 they made 3.1 billion in profit. So that's amazing. They have been growing tremendously well. They have a market cap of $167 billion already, and it has been massively increased from the previous years. As you saw, the stock price has been elevated tremendously in the past couple of years or so. Interesting things to notice here, that the total liabilities of the company is what I wanted to check, which is sitting at about 5 billion, yet the total equity of the company is 7.5, it's 2.5 billion more than the total liabilities. And the cash flow statement here, the cash from operations is positive, and look how much positive than what it used to be in 2017, has almost grown 3.5 billion, so, which is great. And the company is investing a little bit in market securities, but other than that, it's just some capital expenditures and nothing else. And the company is also repurchasing common stock. In 2021, they did repurchase stock. I'm not sure about this move, to tell you the truth. We need to examine the valuation of the company, and they purchased $2 billion in stock, and their stocks looked like it was way too high up there. Now that doesn't mean it was overvalued. We will examine that, but it's interesting to notice that they actually purchased 2 billion when the company's stock was actually higher. And actually, I wanted to take a look at something that I forgot: the shares outstanding here. Okay, so the company has been diluting investors, yes. So they have been actually issuing more and more shares during the years that the stock was going higher, and even before that. Actually, that's a bad sign. In 2014, the company's stock price wasn't even increasing, or 2016. The moment look at the chart right below this one, the historical price graph. The moment they started getting some increase over here in the price of the stock, this is when they started issuing more shares here, as you can see. And yeah, this is a move that many companies do, and it makes some sense. But as an investor, you don't really like to see it because you get diluted. So there are two ways to see that. The company is doing the right thing in the sense that they are actually selling overvalued stock. If it's overvalued, that's important, because they are actually issuing more. but they also diluted the investors who have already invested in the company, and that's not great. So it's a double-sided coin, I suppose. And the next thing, we want to go back and examine the cash from financing here, which we didn't. Actually, we did to look at that. The repurchase of common stock is the story. The free cash flow from losing money actually to 3.2 billion again in 2021, and look at 2020, 700 million, which is fairly close to where it was in 2019. There was explosive growth in 2021, but remember that it's just 1 year. We don't know what's going to happen in the next few years. We don't have enough data, and we can't go off of this steep increase here for our valuation and our projection over the next 5 or 10 years. So the multiples here are pretty high, as I would expect. The enterprise value is high relative to sales, so that's something that I would expect. It's pretty high actually here. The profitability of the company is pretty great, though. Return on equity of 47%, that's amazing. A return on assets of 21, 31 on total capital. So the company is actually utilizing equity, stockholders' equity, and the capital that is deployed within the company in a great manner in order to be able to produce more out of that investment, out of that equity. So they use that to make profit, and they use it in a very, very nice manner here. So that's great. They have massive returns on equity, very, very good for the company. That actually gives me a little bit more confidence. So if I have, let's just say, some doubt, I could actually pay a little bit of a premium because of that, of these values here, just because the company is investing their equity in a fantastic way here. The company has very little debt, as you can see. Total debt to equity is sitting at 10%. And remember that their free cash flow was 3.1 billion just in the last year, and their total liabilities were 5 billion. So they can pay even their total liabilities, not even the total debt, total liabilities, which are more than the total debt, in like 2 years of free cash flow if this story continues here. So there are some good things going on here with AMD. But we do want to take a look, because the company seems to be growing great, but it's a different story when we are purchasing the stock, because you have to always think about the stock and the company as two separate things, completely different things. Because you may have a fantastic company, but a very overvalued stock that backs that company. We want to be getting a fantastic company and a fantastic stock price. That's what we want to be getting. Otherwise, we can wait in the sidelines and buy other shares, other stocks, other companies, while there is a potential decrease that would allow us to buy a company. We need to be objective about it and not just buy a company just because it looks great and it's making some good money. It needs to be that the stock price also attaches what we're seeing in terms of the financials, so that we can get it at a fairly valued price or undervalued price. We don't want to be paying more. That's very, very key when investing, and many people don't understand that. They're like, okay, I'm just buying this because it looks great, because it's making tons of money, but that's not how it works. It needs to be making tons of money, and it needs to be cheap enough for you to enter the company. Very, very important. So let's take a look at our stock evaluation here, and you will see what we have been seeing previously: explosive growth in the last couple of years, and explosive growth in some of the free cash flow over here as well. Look at that, just because the last couple of years have been amazing for the company. But we have our handy averages here, the little table that can really help us with our projections. You will notice that the 5-year average revenue growth has been 32%, 39, and 68, which is fantastic growth, really. I mean, the company has been growing tremendously well. So I'm gonna give it, I'm gonna give it a little bit of actually high potential projections for revenue, which I typically wouldn't give to most companies, but it looks like this trend will continue for the next 5 years. So I'm gonna go let's go 18, 22, and 25, which if you are going on on a 10-year projection, you don't want to use these high values. You want to use much less, maybe 10% or so, 10, 12. But for a 5-year discounted cash flow model, which this one is, I think that makes sense, and I could see the company very well achieving these figures, actually, 18, 22, or 25. Looks like they can achieve that. The net income margins are not great here, and in case you are not aware of what that is, it's basically how much of our net income we keep based on the revenue. So if we divide the net income of the company, how much we're getting back from that. So for instance, we have 33 million here that we lost. And so if we divide 33 to 5 billion, this is minus. This is a minus. But if you take a look at this, for instance, which is 2.49 billion of net income, the question we're asking with net income margin is how much of our revenue was converted to net income. And this is very, very important because we want to examine the profitability of the company, and we want our model to take into consideration the profitability of the company. And this is what we're doing here. We're dividing this value to this value, and we're getting that 25% of the revenue is converted to net income. Very, very important. And this kind of discounted cash flow model actually takes into account this fact. And so we can actually use a net income margin that's going to be maybe 10, 12, and 14 here. I think that makes sense. The free cash flow margin, on the other hand, is how much of our net income is converted to free cash flow. And that's also very important because now we have profit that gets converted to free cash flow. Because free cash flow can be all sorts of things that is not real profit. For instance, depreciation can be free cash flow. And then that can skew our discounted cash flow model if we only look at free cash flow. And this is why this model goes further and goes deeper to examine the actual net income and the free cash flow and their margins between those in terms of the revenue, net income, and free cash flow. It's a much, much better model than actually just using a free cash flow. For instance, stock-based compensation. Did you know that this is actually a positive value in the free cash flow? It's added back to the free cash flow. That can deeply skew your results. But if you use the net income margin here, you have a much, much better estimate because you are taking into account the actual profit of the company. And this is what we're doing here. So yeah, this tool is can really help with automating all this. So 62%, 71 for the 3 years, and the last year 101. So I'm gonna go, let's go 50, 60, and 70 here. And the annual return, I like to use 13%, which is better than a typical ETF, which is S&P 500 ETF. That will give me back 10% a year. 13 is fair, just for taking the risk, the extra risk of holding a single stock here. And calculate and see what we're getting. And as you see, you may be seeing a value that you didn't expect here. Look at that. We are way, way more overpriced than what we would like to get here, aren't we? So this is why it really pays to examine the actual free cash flow of the company and the actual projections of free cash flow for the next 5 years. Because if you do that, and if you use the actual values, the actual figures that the company has been making historically in the last 5 years, is what we're using here. Going back by these figures and also being already a bit conservative with these values here, we are still getting a low estimate of $14 to buy the stock now in order to be gaining 13% a year. 24 is our medium almost, and 36 is our high estimate. But the current price of the stock is 104. And now you can see that this company is a fantastic company, but a very, very overpriced stock. And this is why I would stay away from AMD right now and wait for a massive decrease, a massive reduction of the stock price in order to potentially enter the company. I love what the company is doing. I don't love the stock price. So this is what I had to say about this company. But let me know if you do hold AMD. What do you think about it? And just leave a comment and tell me. Do you think that it's gonna be a potentially interesting buy soon? Maybe it will go down more. What do you think? Thank you for watching the video. Thank you for being around, and thanks a lot for a lot of your comments. It looks like the channel is gaining quite some traction. We're getting more and more members, more and more subscribers, subscribing and liking the videos. I love to see that. Thanks a lot for the support. If you haven't subscribed yet, please do. We'd love to have you around. And please like this video as well, because that really helps with the algorithm. We can bring the content to more people. And you may want to subscribe because eventually you will be gaining access to this tool. I'm gonna make it public for the subscribers of the channel and the viewers, of course. So thanks for watching this one, and in the meantime, take a look at this video that I made about Alibaba earlier. Very, very interesting one, talking about what's going on with the stock, because it looks like it may be a fairly good opportunity right now. So thank you for watching this video, and I'll see you soon, guys. Bye-bye.